Hello, everyone. We see that quite some are still joining, so I'll wait maybe another minute or so before we start the panel. So for everybody, except for the speakers, feel free to have your video on or off as you want, and just make sure though to mute. Great. So, okay, I think we're about a minute over time, so I'd say we give it a go. And so thank you to my speakers for all being here. So it is Rosie, Clara, Ursula, and Julia. So this panel, we called it Talking Tokens, but clearly we're not tokens that are talking, so we're going to talk about tokens. We're going to talk about the tokenization trend in general. I think some of you may be coming from the crypto asset sector, and clearly crypto assets have led to an evolution in financial services. And the question as to whether broader financial services, including, for example, equity markets, but also new markets like carbon credit markets, as well as currency-related instruments, can be built on blockchain and tokenized. So in sum, that is going to be the focus of our panel, and our speakers will come from very different perspectives. So Rosie will come from the Goldman Sachs perspective, which is the bank perspective. Clara will come from our ex-regulatory perspective and currently regulatory advisory perspective. Ursula will take more of a legal angle, and then Julien will come from the perspective of what opportunities tokenization creates for an exchange. So with that, I will first ask each of you to introduce yourselves, and maybe we can go in the order of Rosie, Clara, Ursula, and Julien.
Sure, happy to kick off. Thank you very much for having me, Benedict. So as Benedict mentioned, my name is Rosie Hampson. I'm an exec director within the digital assets team here at Goldman Sachs, based in Hong Kong. So as a team, we focus on everything from asset tokenization, digital money initiatives, cash settled crypto product offerings, all the way through to actually making strategic investments. So I'm very excited to kind of share some of the projects that we're working on with you today, but equally looking forward to hearing from the fellow panelists and getting into the topics.
Great.
Hi. Yeah. Hi, it's Clara. Clara Chiu, and previously, as Benedict has just mentioned, I work at SFC. I was the FinTech head and also Director of Licensing of the Hong Kong Securities and Futures Commission. I stayed there, worked there for 14 years, and I left the SFC last year and started my own consultancy firm. And I was the core architect of the Hong Kong VA regulatory regime, including the VA trading platforms and also VA crypto fund. And I also designed the whole licensing process, approval criteria, and approved the first VATP and crypto fund in Hong Kong. Yeah, I'm very glad that I have the opportunity to join today's panel, and I hope that I can share some of my experience.
Ursula?
Hi, everybody. My name is Ursula Mccormack. I'm a partner of Kingwood Mallesons, and my practice is all about financial regulatory and data regulatory issues, particularly those facing the digital economy. I've been in the blockchain and virtual asset space for a good 6 years now, working with the FinTech Association on developing best practices for token sales. Way back when, being hauled in to speak to Benedict, I remember very, very clearly after the first ICO we ran when she was still at the SFC, and obviously working with Clara on the FinTech Advisory Board at the SFC, and really following this whole growth story with our clients. So everyone from people who are issuing weird and wonderful things in the DeFi world, right through to some big growing exchanges, and then the banks around town.
Great. Julien?
This is such a great panel. I'm very proud to be part of that and honored. So I'm working for Hong Kong Exchange. I'm in charge of an activity that was set up by our CEO as soon as after he joined last June, which is called Emerging Business Development. In the Emerging Business Development, we are looking after obviously digital products, digital transformation, data business, fixed income currency, post-trade developments, and of course ESG, which is a very, very important topic as well for us. So very happy to be there and share some perspective of an exchange in this respect. Thank you.
Great. So thanks for the introductions, and let me kick it off with the first question for Rosie. So Rosie is now at Goldman, and I was at Goldman back in the early days in 1997. And I was taught at the time that change is the only constant. So you better embrace it, right? And you better constantly change as opposed to changing in very big moves, because by the time you change in big moves, you're probably too late in your change. So with that in mind, I'm absolutely not surprised that Goldman is looking into tokenization and make sure it is part of the movement and understanding the movement and the impact on your business. So Rosie, could you elaborate on the aspects of tokenization that from a Goldman perspective you are most keenly exploring, or that you think are going to have a significant impact on the financial industry?
Sure, kind of very, very happy to share. I think I'll just set the scene in the first instance, if that's okay, in terms of broadly what we work on as a team, as I think that will kind of show the audience and illustrate the types of technology projects that we work on. So the team at GS, we span US, EMEA, Asia. We're supported by a dedicated engineering team as well, and we work on a breadth of projects, be them kind of blockchain applications to actually capture operational efficiencies, accessing new markets, mobilization of traditionally illiquid assets, and kind of that's the tokenization part, which I'll touch on a bit more, all the way through to kind of partnering with clients to help drive their digital aspirations across debt, equity markets. We work on digital money initiatives, so be them CBDC or stablecoin consortiums, and additionally, we make strategic investments across the digital assets ecosystem. And finally, we do have cash-settled crypto offerings. You may have seen in the news this week with regard to our kind of OTC cash-settled options product that just launched. And Benedict, to your point, we were actually first to market on this, so we're really excited about the developments thereafter. There's plenty of blockchain applications for blockchain, and perhaps I can just focus on a couple of the ways that we have used it recently that will really articulate how we see tokenization. So last year, we worked with the European Investment Bank to issue the first digitally native bond on public blockchain. And the cash leg of this, interestingly, was actually denominated in a synthetic CBDC. So we're really excited to think about how we can continue to evolve this process for our clients. And then when we think about the secondary markets, once you have the token, you can fractionalize it. You can have a kind of smart contracts built in for the asset servicing component of the product or whatever you need during the life cycle. And this then opens up a kind of a plethora of opportunities. So these projects are already happening, and it has really highlighted to us the need to ensure that we have the right infrastructure in place to provide the ability to service our clients in interaction with CBDCs or other such digital assets as applicable to them. And I think we'll touch on a few of these later as we talk about kind of CBDCs and stable coins. Additionally, another item I'd like to highlight, so GS, along with a consortium of banks and custodians, we're actually working with a company called HQLAX to digitize collateral swaps. So this leverages blockchain to represent the asset in a token form, and then we facilitate the atomic swap via the blockchain. So this gives us the ability to create secured intraday markets for liquidity by mobilizing typically illiquid assets, while also providing obviously risk reductions due to the instantaneous nature of the settlement, which is really exciting. So I think the applications and use cases are endless. And honestly, we're only just starting to scratch the surface on the possibilities that this technology will present.
Great, thank you. So similar question to you, Julien, from a HKX perspective. So you mentioned you're in charge of different areas of emerging business, including bonds and also ESG. So wanted to ask your take on how you see the HKX, how the HKX sees this landscape actually evolve.
I think we're seeing the. I mean, first of all, we're separating the products from the technology, and I think that's probably what the last couple of years have been about. I think every single financial institution, every single infrastructure provider is looking at the benefits of what blockchain technology is bringing to certain aspects of our business. I mean, that could be around KYC, that could be around trade settlement, like we've done with Synapse. That could be around tokenization of new products. That could be looking at bond tokenization, obviously existing digital native or actual STOs. We could look at anything, to be honest, thanks to this technology. Obviously, in Hong Kong, we do have some barrier when it comes to going into crypto, and I really want to make the difference between using crypto and using blockchain in this respect. For us, where we are going to be experimenting a lot of new use cases is really going to be around the powerful aspects of tokenization. And that could come through all of the aspect of the kind of value chain that we operate on, from the trading angle to the generation of new products, to the financing angle, to even topics. We could be using tokenization to promote better governance, voting, diversity, any aspects that we could be looking at, in many of the markets that we operate. So clearly on our side, we think that there's a big angle around carbon. There's a big angle around fixed income and then mitigation outcome instruments. So I'm also very excited to work with you on the Genesis project, for instance. And there will be a lot of implication. I think, as Rosie mentioned, it's all about use cases. Everybody's going to have use cases. Some of those use cases are still a little bit far off and more research-based. Some are actually going to really change the way a lot of the infrastructure is going to be implemented globally. And when you look at CSDs, payment systems, cross-border exchanges, FX, all of these industries are going to be disrupted by atomic settlement and much more efficient processes. And the question is, who's going to survive? It's probably the first time in a very, very long time we see this kind of big bang that can really reshape and disrupt so much of our financial processes.
Great, that was a great introduction, Julien. I agree. It's really it's so multifaceted that it attacks multiple vectors at the same time, right? And different aspects of the financial markets. So over to you, Ursula. So there's a lot of talk in town or across the globe, really, about CBDCs. And also out of my innovation hub, we are running a wholesale CBDC project. So I wanted to get a little bit of your take on how you see the legal landscape for CBDC.
Yeah, thanks very much, Benedict. Yeah, this is a really interesting story, and not because I find the legal aspects so incredibly interesting, and I could bore you all day with them, but because of what they can help us achieve. And you would have heard from Rosie and from Julien as well, some of the ways in which, assets and transactions are becoming more dynamic, more efficient, and more innovative. And so really when we talk about central bank digital currencies, it's the story of innovating money itself. It's looking at the ways in which we have inefficiencies in the way in which money operates, the way in which it circulates, the way in which it flows, and all of the compliance aspects that flow from that as well. And just to sort of recap, a central bank digital currency is just looking at how we make that claim against the central bank move into the digital era. And so when we're thinking about the legal and the regulatory issues, we're thinking about a few sort of key things. The first being what it is that we've created in the first place. Is it simply renovating the market infrastructure, the actual payment mechanisms, the account structure of the way in which that central money is already held, or are we completely rewriting everything? And in the wholesale space, we see less of the complete rewrite than we do for markets that are looking at a retail CBDC or indeed have launched one. So, the Chinese central bank digital currency, the ECNY, is fundamentally changing the way in which money operates. But generally speaking, in the wholesale space, what we're thinking about is how those account structures will work, how settlement finality will work, what it is that we're creating, and does it unintentionally trigger some laws that we don't expect. So in some markets with the growth of virtual asset specific laws, we don't necessarily want fiat currency that's represented in digital form to fall within those frameworks. But the other thing that often comes up is all the ancillary stuff that needs to flow from money. So when we create a wallet to support, or an account structure to support a CBDC, how does that tie into the existing regulatory framework? So for places like Hong Kong, we're thinking about the stored value facilities regime, the banking and the deposit regime as well. And then importantly, and this ties into all of the work that's going on in another important area around stable coins, is how the actual assets, flow, and those representations of assets flow, and then the AML related and sanctions issues that flow. And I know that we're going to be talking about that, in a bit. But the final most interesting thing is interoperability, making sure that, yes, we create something that may work in one market, but how does that connect up into others? And so the project that Benedict's leading, Mbridge, super interesting, as well as Project Dunbar with a report just released in recent days, looking at how the interoperability of those CBDCs can work in practice to fix pain points around things like cross-border trade.
Great, thank you, Ursa. So tying up what you said with what Julien earlier said, so you mentioned this atomic settlement, right, as being very important. So Julien, from your perspective, how important is a currency that atomically settles for, let's say, if the HKX develops tokenized products? How important is this? Now, maybe for context, as part of Genesis 1, we did explore whether it was an absolute necessity to have a CBDC or stablecoin, or whether we could connect to the standing Hong Kong infrastructure. And we concluded we could connect to the standing Hong Kong infrastructure. So it's possible. But so what is the alpha really of having a CBDC or maybe CBDC-backed stablecoins for settlement of, for example, HKX-listed assets?
I mean, it's life-changing. It's going to be completely changing many aspects of the way we are going to be operating markets, and especially cross-border transactions. I mean, I'm personally a lot more excited with wholesale CBDC than retail CBDC because wholesale CBDC are really going to be, again, challenging a whole lot of the current payment infrastructure that we are using, and that are all the more in questions with the current geopolitical situation. So I think, it's building up new payment models whereby investors in any countries can exchange currencies atomically, central bank, covered by central bank to central bank, without having to always go back to the dollar for multiple crosses and multiple margins. I mean, the amount of money that is going to be saved by investors, corporates making payments when they operate this kind of cross-border payments will be immense. And when you think also of the amount of money that stays with banks when they arrange T+2, T+3, and so on settlements, right? When all of that disappears, obviously, we'll have far less intermediaries in the world, and we'll have far less money left on the table. So I think at the end of the day, it's going to just, add so much oil into into the system and facilitate so many more exchanges. And I think we need that in the current environment. We need that so much in facilitating more cross-border payments. We've looked at the mBridge project as a very good test case on our side to facilitate payments, for instance, when it comes to Stock Connect or Bond Connect, or even direct investment into Hong Kong dollar. And one of the use case we looked at was really for instance Thai investors coming directly and buying stocks in Hong Kong dollar through Thai dollar exchanges between the central banks. And when we looked at the research element of that, the amount of time and money that could be saved with this kind of systems is really immense. Of course, there's a lot of work still to make it super resilient. We need to work on the AML and quite a few other aspects, but the power of the smart contract is really to keep so much transparency and keep so much efficiency that it's really going to be life-changing.
Thank you. Yeah, on the AML side, I think as long as it stays a two-tier system with the intermediaries involved, in fact, the approach to AML does not materially change. And interestingly, to your point about the difference between wholesale and retail CBDC, for retail CBDC, it can materially change. So I think different people feel passionate about different things about this topic. For example, from a legal perspective, retail CBDC is a lot more complex than wholesale CBDC because the central banks may not have the power to do a retail CBDC, whereas to operate a wholesale system is within their standing powers. That's why they have RTGS and FPS systems, for example. So yeah, so I think different people have different passions around this topic. So Rosie, you mentioned stablecoins in your prior intervention. So I wanted to understand your view on CBDC stablecoins. Just for context, we also have a third project sitting in our innovation hub, which we call ORAM, which stands for Latin word for gold, which is a Hong Kong retail CBDC project, and it looks at two different two-tier approaches. One is a hybrid CBDC, meaning it is directly issued by the central bank. And the other one is actually a stablecoin backed CBDC, or sometimes we call it an e-money backed CBDC. What that means, it is a CBDC primarily issued by the bank and then reconciled versus the CBDC versus the CBDC operations of the central bank. So a slight legal difference between the claim on the bank versus the claim on the central bank. So in sum, you mentioned for the EIB bond that it was a synthetic CBDC, and a synthetic CBDC is normally a stablecoin-backed CBDC. So I wanted to understand better what happened there exactly and why that structure. Is it because there wasn't a CBDC yet, or are any other reasons?
Yeah, happy to touch on that deal specifically, and then more broadly about kind of our view on stablecoins and CBDCs and their potential coexistence. So for the EIB transaction last year, it was primarily because there is no digital euro at this time. So hence kind of a synthetic version was used to illustrate a CBDC's potential usage and the role it could play in the transaction. So that was the reason for a synthetic at that time. Obviously in future, we hope that there will be CBDCs live that we can actually use in reality for these types of transactions moving forward. I think fundamentally when we think about CBDCs and stablecoins and tokenized deposits, there is certainly a necessity to look on them at a use case by use case basis. And that's how we think about it when we see whether there could be coexistence with these types of digital monies in future. I think, for example, when we think about real-time cross-border settlement use cases, and this was touched on in some of the examples, Benedict, you mentioned earlier with the work that BIS is doing, but there are clear opportunities for CBDCs. And while kind of RTGS systems do work well domestically, they have some limitations when you think about cross-border settlement and payments, etc. And so therefore, potentially the introduction of CBDCs in this type of use case would bring efficiencies and kind of cost reductions as well. When we think about CBDCs, and Benedict, you mentioned this with the third project that BIS is running, it's very important to think about the structure of the CBDC model and distribution model as well. And one of the items that we're looking at in quite a lot of detail with the models that have come out is the potential balance sheet implications of CBDCs. If we think more broadly about this from an overall impact perspective, it's definitely too early to say the full impact of CBDC adoption, what it will be. But across the CBDC papers that have been released, there are multiple models cited from kind of various involvements of commercial, retail, and e-money providers. But some models do highlight 100% CBDC-backed requirement, which would naturally bring some potentially inefficiencies from a banking standpoint. And that slack in funding would then have to be picked up by the wholesale funding market, which would naturally be more expensive. So it's equally clear to see that CBDC reports from central banks are looking at how potential disintermediation could be mitigated, for example, setting penalty rates on holdings above a certain level, balance caps, etc. So all of these items from a business perspective is something that we're looking very closely at to see how we could mitigate some of these potential challenges that a CBDC could bring about. Overall on CBDCs, and to the point that Ursula made, it's very important that central banks think about how their CBDC will operate internationally. So this is both from a kind of monetary compatibility, but also a tech interoperability perspective. And so we're working on a number of projects with the industry to consider these items. We're already seeing commercialization of blockchain projects, such as the work that I just talked about with EIB, and these projects are happening. Equally, we're seeing custodians introducing digital asset custody wallets, which will go hand in hand with CBDC custody, obviously in due course as well. When we think about stable coins or tokenized deposits, the use cases here are very evident across interbank and wholesale markets. And for example, we're looking at repo, margin, and kind of collateral use cases and scenarios to leverage the stable coin or tokenized deposit to represent the cash leg. And this will bring about kind of significant operational savings, reduction in interest expenses, as you can settle to the nearest minute that the blockchain allows, reduction of risk, and overall just a greater transparency of the process and the flow, which obviously I don't need to articulate the benefits that can be derived from that. So for CBDCs and stable coins and tokenized deposits, I think the tenet here is really we need to be prepared to ensure that our infrastructure can interact with these monies. And this is for both ourselves, but obviously for our clients, so that we can see this potential coexistence in due course.
Yes, thank you. Understood. I think maybe just to disentangle one piece of discussion here is that the central banks are well aware of the risk of full backing for a CBDC, right? So a CBDC would highly likely be using the same model as exists today, which is the fractional reserve model. However, for plain stable coins that are not CBDC, that is where the discussion exists around whether they should be fully backed or not. And the current existing stable coins are let's say the better quality ones are fully backed. So I think we need to disentangle there the CBDC discussion versus the stablecoin discussion, even though, as said, in practice, technology-wise, they could come together, but then we would consider them a CBDC versus if there is no central bank involvement in the issuance of that currency, then it is not a CBDC. So maybe to go now to Clara. So Clara, as you mentioned, you were very much in charge of drafting the first steps of the virtual asset regime in Hong Kong, which at the time was an optional regime and which is now being moved to a required licensing regime. So I wanted to maybe get your thoughts on this, the thinking process, and also how you see Hong Kong's position today, like whether you think we're well positioned for the future of virtual assets or not, and let's say what are our strengths and weaknesses in this regard.
Thank you, Benedict. I think the whole journey to create the VA regulatory framework in Hong Kong was a very interesting and challenging one. When I was asked to consider what the SFC could do for the fintech industry back in 2017 at the time, I came up with two ideas. Mainly at that time, my focus was on robo-advisor, those kind of asset management, online asset management trading platform using technology help like AI. And then the other aspect was virtual asset area. And then for robo-advisor area, the thinking could be quite straightforward because most of those kind of asset management activities are already or should be within the SFC jurisdiction or financial security regulators jurisdiction. So at that time, we consider that we just needed to clarify with the industry, telling them that they could do that, and then what we expected, and then what would be the criteria for people to engage in those kind of business. And then for the virtual asset side, it would be more complicated. At that time, it was at the peak of ICOs. And there, as you know, there were a lot of fancy projects in the market. Some of them really, really fascinating. Some of them are kind of like a scam, when you look back now. And so at that time, there was an intense debate, not just in Hong Kong, I think it's globally, whether a financial regulator should regulate virtual asset area cryptocurrency, and then whether it should be, whether financial regulator should regulate, and whether it should be regulated by, let's say, banking regulator instead of security regulator, because cryptocurrency is the currency mark there. So it's more like the banking side. But when you think about it, like those ICO coins, even though they are cryptocurrencies, they're kind of like investment projects. So if you think from that perspective, then it would be more, security regulator jurisdiction. So there was a kind of a lot of debate about it. And in any event, the big question at that time was whether we should regulate or not. And as I saw at that time, I believe there was a lot of overlapping between the crypto activities and the traditional financial activities. Like, it's kind of like collective investment schemes, some of them, with fundraising side. And then, at that time, the investors' sentiment, where they're, chasing after those projects. So I thought it was, it would do investor good if we have some kind of regulation about it. And at the same time, maybe, I don't know whether you imagine some crypto platforms, in fact, they really, really wanted to get a license from regulators. They want to make their business, more legitimate, because they thought that they're running kind of legitimate business. Why? Sometimes they encountered difficulties in opening bank accounts. People doubt them whether they are in some dodgy business or involved in those AML activities, not AML, money laundering activities. So some of them really, really would like to get a license and be regulated by the securities regulators. So they also came to us and asked us whether we could consider to grant them a license. So that's all the reasons behind. And then finally, we decided that, yes, maybe we could design the whole VA regulatory regime. So I was the initiator and creator pushing all these projects, because I thought with virtual assets regulatory regime in Hong Kong, it would do good for the investors and the industry as well. And it's definitely good for market development, because for me, I'm a strong believer in regulatory clarity. If you have good regulation, provide clarity as to the industry player, what they could or could not do, then they could be properly licensed and supervised. It helped the industry to develop in an orderly manner. So that's my belief. That's why, we have the VA regulatory regime in Hong Kong. And talking about the forthcoming new regime, that new regime will be under another ordinance, not the Securities and Futures Ordinance. It will be under the Anti-Money Laundering Ordinance, AMLO. So what we usually call that new regime, we call it AMLO regime. And I guess the new regime will be substantially similar to what we are having now, the opt-in regime under the SFO, because as regulators, always we try to avoid regulatory arbitrage. So the two regimes will be the same. And then the licensing authority for the new VA trading platform license under AMLO, the new regime, AMLO regime, will also be Hong Kong. In Hong Kong will be, of course, SFC, Securities and Futures Commission. And then the main differences between the existing opt-in regime and the AMLO regime will be, firstly, under the new regime, trading platforms do not necessarily need to trade any security token in Hong Kong because the SFC already has jurisdiction over them under the AMLO. And then the other one is it won't be an opt-in regime in the future in Hong Kong. If you are running a trading platform operating in Hong Kong or targeting Hong Kong people investing public, then you have to get a license from the SFC under AMLO, otherwise it will be illegal. So I hope that I'm clear on this.
Yeah, that's very clear, Clara, and really interesting, because obviously as an outsider, it always looks simple, like this decision about regulating or not. But I mean, anecdotally, since indeed I was one of the first to look into Bitcoin while I was at the SFC, I still remember in the very early stage, it must have been somewhere around 2014, there was a relatively big scam. Like it was like hundreds of, like a couple 100 million, I think it was, in Hong Kong dollars. And, you know, there was absolutely no complaints with the SFC, which is very unusual, because if something is regulated and there is a fraud involved, then we will get them all knocking on the door. But because it was unregulated, and we had amply said it's unregulated, when people lost a lot of money, they actually didn't come to knock on the door. So in an interesting way, in the early stages of an asset, like this asset was, it's actually sensible not to regulate it. But then, as you say, at some stage, the balance then shifts when it's not just a few people involved, but it's like many, many millions across the globe involved. And then it becomes, you know, it must be regulated. Now, Ursula, you mentioned that recently there was a circular by the HKMA clarifying what banks can do in the space. So, and you mentioned that as far as clarification goes, that is a pretty significant move, and maybe even world class in terms of having clarified the position. So could you elaborate on that? And then separately, do you see a risk of regulatory overreach, or do you think things are now moving in the right direction? And maybe let me add one thought there. My feeling is finally people are disentangling the crypto assets, which are indeed more like assets and fall under securities regulation increasingly, versus the payment aspect. And within the payment aspect, the CBDC and the stablecoin that we previously discussed, which come much closer to payment and bank regulation. So in sum, over to you, Ursula.
Yeah, thanks so much. Yeah, look, so yes, so HKMA published with the SFC joint announcement in January, as well as its sort of own circular. I think what's especially important about that was the arc that the HKMA had travelled to get to a point where it provided quite clear guidance to the industry about what it expected. And, you know, we had a regulator who was amongst the early regulators to start signalling warnings in relation to virtual assets and potential linkage into money laundering and terrorist financing a long time ago. But it now has signaled a risk-based approach to the sector and encouraging banks to do the same. So we have, as an industry, had a vast problem, which Clara has alluded to, of effectively leading and requiring exchanges to operate in the shadows, out of the traditional financial market and system, and therefore led to the growth of a lot of other assets, including stablecoins, because of the inaccessibility to fiat on and off ramps. And so this really was the culmination of a lot of years of looking at it now far more, in a far more sophisticated way, also recognizing how far exchanges have come themselves. So becoming regulated, having those frameworks in place, being able to leverage on-chain analytics to provide far more transparency in relation to source of funds than you could ever do with cash. And really allowing banks to have a pathway forward. The banks I deal with, some are very sophisticated, many participants on this call, amongst them, others very nervous, and simply because of uncertainty around what the regulator think, will simply not bank the sector. So that clarity now is super important. But in terms of regulatory trajectory overall, really what we've seen is, if you can draw an analogy of a racetrack, you have a regulator who has spied this racetrack, can see cars going around, something's going on, heads are turning, just can't really sort of keep up. And you've started to see regulators really join in that race. And at first it catch up, really trying to chase these, like incredible machines, work out what's going on and seeing what they are. And then over time building, better cars themselves. And in the case of the SFC, borrowing, the race car that they had for the securities industry to be able to create a framework that can really meet this new challenge of these incredible machines. But really what we also see is some regulators deciding, well, let's just shut down the racetrack, or we'll shut it down for certain people because it's just too risky. And to your point, Benedict, I think that in the early days, the prevailing wisdom was don't put more money into this than you can afford to lose. Pretend this is going to Macau for the weekend, just recognize that this needs to be taken with a grain of salt. It's experimental technology. And I think as it's grown in adoption and perhaps, penetrated a deeper market where that understanding of buyer beware has been lost, and perhaps through even the marketing efforts of the platforms themselves and scams online, it's a shame that we've lost to a degree that ability for people to access risk as regulations are becoming more stringent. And in particular, it worries me that we see, real shutdown of certain segments of the market to even accessing the sector at all. And, all of you on the call, I'm sure will be aware that that is one of the key proposals for Hong Kong is a live requirement already for licensed institutions that they don't provide any access to retail participation. Now, in the sort of spirit of what the sort of crypto industry was, that is quite antithetical. It's antithetical because it was intended to increase financial inclusion and increase the ability of people to be involved in the growth story of technology. And so something is lost when we close down that racetrack only to those with the fastest machines and the ability to bear all impossible, all loss. So it is interesting to see other markets taking slightly different approaches. In Singapore, we don't have the same restriction, but we do have a restriction now on advertising on trains, buses, planes, in the broader arena. So that information, the products are available, but it's not in everybody's face, and there's some controls around the advertising. Other markets, to your point, Benedict, are starting to differentiate between tokens. So we see sophisticated regimes in Thailand, Indonesia, Philippines, and some of those markets are differentiating early stage tokens where they are in the nature of investments in that sort of ICO ramp up phase and may need to be, sort of limited in terms of accessibility versus ones that are operating in the market. So I think, I would like to see over time, and I'm hopeful over time that Hong Kong will increase participation.
Thank you. So clearly a lot going on, but at least I think the train is moving in the right direction now. So and as you said, it's like a race. And in the beginning, there was just a few horses racing, and that was a real problem because then the rest of the countries are letting things happen without regulation, right? So it's actually a more equal or a more level playing field if all the horses are running, right? And so let's assume that ultimately they figure out that they all need to run in one direction.
Yeah, look, absolutely.
And hopefully not be that far away from each other in terms of, how they're running and their running styles, so to say.
Yeah, and also the other piece to that is just making sure that the regulatory teams, and I know they are not, but working in silos. So if we're looking at the regulation of AI, that's not far away from the regulation of decentralized finance. It's all about sort of code and automation. So the bridging of the sort of knowledge and the focus is important too.
Great. Okay, so Rosie, now we want to shift to another favorite topic of people, which is DeFi. And so wanted to ask you what learnings you see in terms of DeFi, including the latest NFT craze, for example. Is there anything that you see will somehow become useful for mainstream finance?
Yeah, it's a great question, and a question that we certainly get a lot as well. So I think with DeFi, it's proven the ability to track provenance, right? And this is much broader than just gaming or NFT art, but it's fundamentally looking at the use of DLT and DeFi specifically to, for example, validate deeds, for compliance and identity verification, for data transparency, greater data analytics, and so on and so forth. So the way we think about data when it comes to DeFi is the same way that in our mind, we have seen blockchain play out. Initially, it was anonymized, decentralized, and then institutions harness this with enterprise blockchain, right? And so likewise, in DeFi, banks recognize the power of the underlying technology and are getting more comfortable with this. And data is a very good inroad here, connecting the kind of on and off chain worlds and proving the benefits of this transparency and kind of data, therefore, is a key component. So there are certainly learnings for both sides of the table, and fundamentally DeFi is really changing the narrative on how data is collected, structured, validated, and delivered. And this is clearly something that in the kind of TradFi space, everyone is taking notice of. And to my earlier comments, you can see the benefits of provenance and transparency. Obviously, we will continue to monitor how we can be involved in this, and regulation has a huge part to play. And to Clara's earlier points, regulation across the globe will provide a lot more clarity, and particularly for more traditional financial institutions such as ourselves, to help build comfort with how to interact with these new types of technology and evolving financial infrastructures. And we're already seeing, as the other panelists have mentioned, kind of regulators forming these views and providing direction to the market, which is great to see. But obviously, there's still a way to go on that to provide kind of full clarity and full transparency on how to interact with the market. So really exciting, a lot of learnings to be taken, and a lot of sharing that is already being done from both sides.
Thank you. So Clara, another aspect about virtual assets is the AML compliance, or sanctions, CTF and AML compliance. So there often is this, let's say, I'm really still surprised by the amount of headlines around virtual assets and a risk of money laundering. And the reason I'm surprised about that is because having actually spent most of my life in compliance, I know that the tools for AML are really not the best, okay? And what that means is they're incredibly expensive. They're incredibly human-centric. So banks employ many people. It's in the thousands to watch these tools, which means that the automation never got to an optimal level. What it means is there's a ton of false positives that humans need to eliminate. So now, if on the other hand, you look at crypto assets, they have a public address. Now, they don't have the identity of the individual that owns that wallet, but they do have a public address, and you can easily track that public address backwards through the life of that digital asset. And so what I'm seeing is that some of these tools, they appear to be better at tracking money laundering than actually exists in the traditional financial sector. And I just wanted to see if you have similar thoughts or what your viewpoint is on this.
Yeah, I totally agree with you, Benedict. Yeah, that is also my view as well. As you can see, like recently, there was a crypto exchange is reported on the news saying, they can cut off more than 25,000 crypto wallets overnight that they believe to be linked with Russian sanctioned parties. That this kind of news, then you can see that, in fact, like wallet address or those or cryptocurrencies, they are really very easily traceable asset at all. And then because the nature of blockchain is kind of like irreversible records ledger, so it's very easy. And even as you said, maybe sometimes even better than the tracing exercise in the traditional banking world. Because as I see it, is that yes, for the crypto wallet, you probably can't know the ultimate beneficial owner of those crypto assets. But in banking, you hold a bank account doesn't really mean you're a legal owner of that fiat currency. Doesn't not necessarily mean that you're the ultimate owner of those cash. But anyway, I think tracing is not as difficult as in the crypto world is not as difficult as it appears to be. And then it's better sometimes because, for example, if you want to do tracing in the banking system, probably only the law enforcement will have powers to do it. But for the cryptocurrency public blockchain area, then a lot of tech companies, if they have those technology skills, they could do it. And so I think that is, in this sense, it's better. The public could also do it as long as you have those expertise. And for the regulation in Hong Kong, for example, when under the Hong Kong VA trading platform regulations, we also ask the licensed platform to do a kind of AML to make sure the coins deposited to their platforms are clean. And so we also allow them to work with some reputable international kind of technology provider who could check or trace the coins back from many, many layers. So we allow these licensed companies to work with tech companies, and then they could provide a very comprehensive measurement or comprehensive comfort to the regulator that they could comply with the AML requirements. So I think that's good. And that is the regulations I see is going to that direction. So not just everything impose and ask the licensed corporation to do it by themselves. We allow those kind of collaboration.
Great. So I want to turn back to Julien now, and because we're going into the last 10 minutes, I think, of our panel. So Julien, here's the fun and difficult question, which is the crystal ball question, right? So if we look at the history of crypto assets, it's not very long in the context of finance, but it is more than 10 years. So it's not like yesterday either. Yet within the mainstream so while in crypto finance billions are moving around every day, in mainstream finance we still haven't seen tokenization taken to commercial level, be it, let's say, at the HKX level or at the banks level. So there's still a lot of experimentation, including within my unit, for example, in the context of tokenizing the currency, which is CBDC. But we haven't seen it yet hit the market, hit the mainstream, so to say. So if you needed to look forward into the future, how long do you think it's going to take? Are we talking 5, 10, 20 years? And then if, let's say, for simplicity purposes, we choose 20 years, how do you think the markets will look? Like how will the stock exchange look?
Well, it's a super challenging question. I think at the current moment, I think most people in this industry, whether they do tokenization or anything, whether they're exchanges or whether they operate any kind of services around blockchain, most people in the industry actually earn a living through crypto. All the rest is still very much, work in the making. Now, you've got two routes. Some people are going the regulated routes, some people are going the unregulated routes. The people that are currently earning the most and having the biggest transactions are the people that are going the unregulated routes, moving from jurisdiction as soon as the jurisdiction comes up with too much of a hurdle when it comes to regulatory regime. So obviously, if I want to be optimistic about this industry, I hope that will change, and I hope that the people that are going through the regulated routes in many jurisdictions are going to eventually be the winners, and not the ones that are trying to evade regulations. So that's my point number one. Point number two is there's one thing which is fundamental in the technology that we're talking about, is that every time I talk to an entity, whether it's a trading entity, whether it's a service industry an entity, or a software company that works on blockchain, they never have the full value chain of what you ask. They always work with many other partners. You talk to one and they say, yeah, I can't do that, but I know these guys, we've been working with them for so long. And so it's a super, I mean, it's an environment where people are really working very closely with one another. But at the same time, I mean, having been, firsthand looking at, providers of infrastructure-based solution for institutions like us, I still think there's a whole lot of work for the software industry to really reach a level that really allows more and more institutional financial institutions to really enter this industry more solidly. So I think that's probably going to take another 3 to 5 years before that becomes really mature. Then the next question is which blockchain, the Hyperledger was launched 12 years ago, but Ethereum is basically where everybody is right now, but a lot of the new Solana, Cardano, and so on, and then new technology is being released every year. What is going to happen with China? There's a lot of blockchain developments in China, which are actually based on self-made blockchain on the other side of the border up north. What is going to eventually become a standard? How are you going to be working all these interoperability between the different blockchains is going to be, in my view, a very interesting topic. And I think that's going to take a little bit of time. You've seen protocols where there's been challenges, security challenges, cyber security challenges. It will require probably another 3 to 5 years again for massive industry infrastructure like us to fully embrace it and maybe switch our entire activity from our traditional centralized ledger approach to this kind of distributed ledger. But I'd say there are some clear parts of the industry that I feel are going to be challenged, and probably within the next 5 to 10 years. ICSDs, definitely, they will need to revisit how they are going to be operating because obviously they're sitting on a lot of assets. It's quite easy to tokenize those assets. I think it was mentioned by Rosie that people are moving to digital custody more and more, and it's not only for digital assets, it could be for also analog assets turn into digital assets. You've got things like data. Clearly, the whole data industry will take a big hit through this whole blockchain technology approach. Anything which has to do with trading, trade affirmation, trade compression, stock borrowing, lending, repo, all of that could have huge, very, very active application models through the new technology. So we need, I want to do, proof of concept on every single of these things, or even sometimes MVPs on all of these things. But we also have to be a little bit realistic. There are some aspects to the software around the technology that still need to be improved. And then there are some fantastic use cases. I think you have some markets that are completely dislocated. If you take the carbon market, especially voluntary carbon market, completely dislocated. There's no pricing. Everybody's wondering where the carbon credits are coming from. I've seen ideas of people doing NFTs around the certification process. I've seen ideas of people building up digital repository and registry for all the carbon offsets, and eventually integration of more and more of those carbon projects into kind of a token-based integrated token with a single pricing, because pricing is a huge problem. And then exchanges of those tokens could be also facilitated. Monitoring of the carbon projects and how much they are actually reducing or generating in terms of capture. Same thing, super exciting things I've seen in the industry of people using blockchain technology to really monitor all of these projects and making sure across the time that your carbon offset is technically viable and worth something, right? So there's huge amount of application. I think it's going to be the technology that we use probably in 5 to 10 years. 20 years, maybe there will be another one that we use. I don't know, but in the meantime, I think we will be having most of our mainstream activities on this kind of industry-based technology, in my view, in the next 5 to 10 years. But the next 3 to 5 years are still going to be a lot about scaling up and making sure that there are all the right aspects to it in order for this to be fully industrialized.
Great. Well, thank you very much, Julia. I think we're right at the hour, so we've reached the end of our panel. So I wanted to thank our wonderful panelists, but also the audience. I saw at some point we were close to 100 here on the line. So thank you very much for attending. And if you want to speak with any of us or contact us, we are all on LinkedIn, so you can contact us via there. So thank you very much, ladies and gentlemen, and see you next time. Bye.
Thank you. Bye-bye.
Thank you. Bye.